Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks slide ahead of key US jobs data that could shape the outlook for interest rates. The Yuan steadies after China's central bank makes a surprise move to stop buying government bonds. 180,000 people have now been forced from their homes in Los Angeles, with firefighters battling to control new blazes. President Biden promises the government will cover the state's costs. And Donald Trump says a meeting with Russian President Vladimir Putin is being set up as the president-elect restates his call to end the war in Ukraine. Happy Friday. So after the tumult that we've seen across the global bond markets, the focus will be, of course, on the jobs data out of the US later today, with an estimate of around 165,000 for the month of December, unemployment at 4.2%. We'll see what the numbers are, of course, later today, and how volatile the markets are and sensitive they are to that data point, whether it adjusts the views. Fed officials, again, reiterating yesterday that they want to see caution in terms of next steps for this Federal Reserve, given the inflation story unfolding stateside. European futures currently flat. The US reopens, of course, after a closed day yesterday. FTSE 100 futures also flat. The focus continues to be on the build-out, of course, of concerns in the UK with stagnant growth, that build-out and the debt load, of course, and what could happen in terms of Rachel Reeves and the Chancellor come next week. S&P futures then, with the US reopening, currently flat. NASDAQ 100 futures also flat. We're looking for that catalyst. There's a bit of a holding pattern, it seems, as we wait for the non-farm payrolls data later today. Let's flip the board and have a look cross-asset then. In terms of the Treasury market, you have seen a bit of calming since the beginning of the week, when you saw, of course, yields continue to edge high. Currently at 4.69 on the benchmark US 10-year. The pound remains under pressure, down 0.2%, falling yesterday to the lowest level in at least a year, 122 right now on sterling. Brent 77.32, currently up 0.5%, set for 3 straight weeks of gains for oil. We'll unpack that story for you in this hour. And gold at 2,675 per troy ounce. The yellow metal getting a lift, up 0.3%. The jobs data then, later today, expected to showcase a healthy labour market, with non-farm payrolls, as I mentioned, probably rising by 165,000 last month. The data likely to support the Fed's focus back to inflation, with economists seeing a pause for the Fed this month. Officials such as Michelle Bowman, Patrick Harker point to a slower approach to easing this year.
I still see us on a downward policy rate path. Looking at everything before me now, I'm not about to walk off this path or turn around. But the exact speed I continue to go along this path will be fully dependent upon the incoming data. We can stay where we are for a little bit, probably not long, but we'll see.
OK, let's bring in our market watcher, Bloomberg's Valerie Teitel, of course, for an assessment of what we've been hearing from Fed officials and then a preview of non-farm payrolls. Val, let's start there then with Harker. To what extent is his view? He still expects to be cutting this year, maybe at a slower rate. Does that align what we've been hearing from other officials?
Frankly, no, Tom. We heard from one of the most hawkish at the FOMC, Michelle Bowman, yesterday. She called December's cut the final step in the recalibration phase, leading many of us to believe that she is perhaps that dot on the dot plot reflecting no more rate cuts this year. She also blamed inflation for the reason as why we're seeing this rise in Treasury market yields. And it was those concerns that backed up her argument why there should be no further cuts for the remainder of this year. And also, very importantly, she mentioned that she backed looser bank capital rules. This is important, Tom, because she is touted to replace Vice Chair Michael Barr as the vice chair of supervision. So she will be very much in charge of taking forward where those bank capital rules go. And speaking of the regulatory musical chairs that we have in Washington, we've heard confirmation that Scott Bessent's Treasury confirmation hearing for Treasury Secretary will take place next week on January 16th. Will be very interesting to see what he thinks is driving this move higher in yields. But before we get to that, Friday, it's non-farm payroll day. Watch out for a blowout number. Very interesting piece from Anna Wong at Bloomberg Economics, saying the high-frequency data, especially when it comes to the home base data, shows that there is a risk for a higher print. Bloomberg Economics is nearly 100K above the consensus, which is currently at 165.
What is more important for these markets today, Val? Is it non-farm payrolls or is it the gilt market?
There is a risk out there that the non-farm payroll print could be very much overshadowed if we see another chaotic day in the gilt market. Interesting to know, though, that yesterday was, frankly, a day of calm after opening up quite on a hairy basis. Gilt yields spiked 11 basis points at the open, but ended the session nearly unchanged. However, there is some very interesting stuff going on in the FX market, Tom. A lot of bank dealing desks out there reporting that there are hedge funds, there are leverage accounts really piling into bearish downside puts when it comes to the cable currency. If we look at risk reversals within the currency pair, they're the most bearish in over 2 years.
OK, Bloomberg's Valerie Teitel, thank you very much indeed. With the setup ahead of non-farm payrolls later today, the gilt markets continue to be in focus. Reopening, of course, at 8 a.m. UK time. To China now, where the central bank is to suspend buying government bonds as yields fall to all-time lows and traders bet on weak economic growth. Let's bring in Bloomberg MLive strategist Mark Cranfield. Mark, how are investors reacting to this news? Came as something of a surprise. They are going to be suspending the purchase of bonds.
Yeah, investors not too impressed. They've taken the bond market down a few pegs today in China. And it's dangerous territory. Central banks, as a matter of course, are heavily involved in their bond markets and their money markets on a daily basis. And traders expect that transparency to continue. They expect it to be part of the general performance of the market. So when the central bank suddenly says, oh, we're not going to be buying any more bonds for a while, that takes everyone by surprise. And it certainly isn't a good message to foreigners as well. China's been making a big deal about trying to get foreign investors back into their assets, especially the bond market and the equity market as well. This is not the kind of signal they want to see. They want to see a market that behaves according to the fundamentals. Fundamentals say yields should go lower. That's frustrating for the Chinese central bank because it's also pushing the yuan weaker as well. You can't have everything. And when you start meddling like this, it is dangerous territory and the investors can see that. This is probably only going to be a temporary measure, but it is something that they will have to think about very carefully whether they repeat it or not, because it's not been taken very well in the short term. There is going to be a briefing next week. Central bank and the other regulatory bodies are going to be speaking on Tuesday. Hopefully they'll clear things up. But these kind of interference in the market, as we've seen with the equity market as well, they tend to put off foreign money, and that's not what China wants.
OK, MLive strategist Mark Cranfield, excellent in terms of the context around this risky move, as he characterises, around the meddling by the PBOC deciding to suspend the purchase of government bonds. Meanwhile, on the equity markets of China, by the way, the MSCI China index closing in to a bear market with a drop now of about 20% since October. To the US, President-elect Donald Trump says a meeting with Russian President Vladimir Putin is being set up. For more, let's bring in our East Asia government editor, John Herskowitz. John, significant if this is indeed happening. How do we characterise this?
Well, it's one of the initiatives that Trump has really wanted to do. We still don't really know a lot about what is going on, or if something has been set up at all. Trump said that if a meeting were to come, it would come after the inauguration. There's no set date, no set time, just this announcement that he's looking to have the meeting. And, you know, they met previously when Trump was previously president, and there's been a little bit of an opaque nature about some of these meetings. At their first meeting in Germany, the New York Times reported that Trump took the notes of the interpreter and didn't allow the interpreter to speak on anything that happened in the meeting. And there's been this closed nature of the meetings, and information has been really closely controlled.
What does it mean, and where does it leave Ukraine?
Yeah, Ukraine is definitely a key part of this. On the campaign trail, Trump pledged to end the war in Ukraine in 24 hours since becoming president. He's backed off a little bit in recent days, saying it could take several months. But there's the worry from President Zelensky that Trump will seek a deal that cedes a large part of his country to Russia. I think currently Russia holds about nearly 20% of Ukraine territory. And while this is going on as a concern for Ukraine, the Biden administration is sticking by Ukraine. It was part of a meeting in Germany of allied ministers to supply military aid to Ukraine. There was a mention of $500 million in aid going to Ukraine. So the Biden administration wants to keep the aid going. Zelensky is worried about what may come forward. And there's some indication that by Trump pushing back the date for some sort of agreement, this could give Zelensky some breathing room as well.
OK, Bloomberg's East Asia government editor John Herskovitz on these comments from incoming President Trump that he is and the team there are underway in terms of working towards a meeting in some form with Russia's leading what it could mean for Ukraine. Now to Los Angeles, where the deadly fire has forced now almost 180,000 people from their homes as firefighters struggle to bring the blazes under control. President Biden, meanwhile, saying the US government will cover 100% of the costs of the California wildfires for 180 days, calling the devastation catastrophic.
So today I'm announcing that the federal government will cover 100% of the cost for 180 days. It's going to pay for things like debris and hazard material removal, temporary shelters, first responders' salaries, and all necessary measures to protect life and property.
OK, for more, let's bring in Bloomberg's Michelle Ma in Los Angeles, who's been living and breathing and reporting on this for us. Michelle, what is the latest on the ground?
I mean, like you mentioned, the latest is about 180,000 people have been evacuated from their homes, and thousands of structures have been destroyed. Unfortunately, today we also heard of 2 deaths from the Palisades fire. And so far, at least 5 people have died since the fires started Tuesday. Now, we also heard from the LA County Sheriff's Department that they've drafted up a 12-hour curfew from 6 p.m. to 6 a.m., which they plan on implementing as soon as possible. And this is going to be in the areas impacted by the 2 biggest fires, which are the Palisades fire and the Eaton fire. And we were told that this was just to keep residents in the area safe. There is some good news. I think, the Sunset Fire, which threatened Hollywood yesterday, has been fully contained at this point, and an evacuation order for the surrounding area has since been lifted.
Where are we in quantifying the damage then and the cost of rebuild?
It's still too early to say. The fire is nowhere close to over yet. The winds are supposed to pick up again tonight. But, what we do know so far is that this is likely going to be the most costly set of fires in California history. We've seen several different estimates. I think the latest one from JP Morgan put the potential cost for insurers at over $20 billion. And that is double their estimate from just a day prior. So, the analyst note also warned that if the losses continue to rise and if the fires aren't controlled, that these losses could continue to rise. So the Palisades fire is only 6% contained right now, and the Eaton fire is 0% contained. And like I mentioned, we expect heavy winds and extremely dry conditions to continue. And of course, all of this adds pressure to the California insurance market, which has already been battered. 7 out of the 12 biggest home insurers have already limited their coverage in the state over the last 2 years. And that's partly because of the increased fire risk driven by climate change.
OK, Bloomberg's Michelle Ma on the ground for us in Los Angeles on the continued risks, of course, around the fires that continue to rage and the cost that is being accounted for insurers and the state more broadly. Thank you, Michelle. Coming up, with the UK becoming the focus of a global bond sell-off, Chancellor Rachel Reeves is under pressure to deliver new spending cuts or tax rises. We discuss the latest next as she heads to Beijing. This is Bloomberg. Welcome back. BlackRock says it is leaving one of the world's biggest climate investor groups after being targeted by Republican politicians. The money manager, which oversees more than $11 trillion, says membership of the Net Zero Asset Managers Initiative caused confusion regarding its practices. BlackRock was among asset managers facing a Texas lawsuit alleging breaches of antitrust laws because of climate strategies that suppress coal production. And this year marks the halfway point in a crucial decade for climate action as the window to limit global warming to 1.5 degrees Celsius closes. Is the world ready to say goodbye to coal, the dirtiest fossil fuel? The move by BlackRock suggests no, not yet. Joining me now is Yumi Kim, an associate in Bloomberg NEF's Asia Pacific Power Markets team. Thanks for joining us. Could 2025 then be the year the sun finally sets on coal? We had a reminder that BlackRock and many asset managers are now reluctant to walk away entirely from these fossil fuels.
Yes, we're expecting coal demand to have marginally increased in 2024. And we think that in 2025 and over the next few years, coal demand will largely stagnate. The peak demand for coal looks to be almost here, but a rapid decline from that point is unlikely. In advanced economies, coal demand has been shrinking from coal phase-out plans and cheaper gas in the US. But in emerging economies, mostly in Asia, coal demand is still very strong. China is dependent on coal power even with its growing renewables capacity. But to be on track for net zero emissions globally, coal consumption needs to fall immediately from today. But even then, we don't see coal disappearing completely as it will be paired with carbon capture for power generation and remains essential for industries like steel and cement.
Yeah, the front page of the Financial Times this morning. The world breaches 1.5 degrees global warming target for the first time in 2024. Talk to us about that China piece of the story then. It's clearly a leader, the nation, in renewables, and the globe is increasingly reliant on the renewable infrastructure of China. But why is that country still burning so much coal?
Yes, China is the biggest driver for coal demand globally. And while its renewable capacity is growing and taking up a bigger share of the power mix, it is still outpaced by the growth in the country's power demand. And such gap is met by coal in China from domestic mines and international trade partners. Coal is also needed to smooth out any volatility in renewable generation, such as hydro, wind, and solar. And these technologies are highly dependent on weather, which can bring volatility to China's power supply.
What does all of this mean then for prices? If we expect demand to remain strong for coal, what is the outlook for prices this year?
Yes, prices have been falling since the beginning of 2023, but it still remains elevated compared with the pre-energy crisis era due to sustained demand. Well, higher LNG prices have been keeping the utilities from switching to burning gas, and that's supporting the prices for thermal coal. But falling prices last year were enough for buyers in Asia to stockpile coal at record high levels. And we're expecting prices to remain stable in the short term as inventories in China and India are at healthy levels.
OK, Yumi Kim, associate at Bloomberg NEF on the deep dive analysis around the outlook for coal at a time when we breach 1.5 degrees for the first time in 2024. That is the front page of the FT this morning. Yumi, thank you very much indeed for the analysis. If you'd like to hear more from BNEF's analysts, download the Switched On podcast on Apple, Spotify, or wherever you get your podcasts. And later this hour, we are going to be speaking with Francisco Blanch from Bank of America Global Research on the outlook for commodities. Stay with us for that conversation. The focus on gas, oil, and the outlook for gold. Coming up, with the UK becoming the focus of a global bond sell-off, Chancellor Rachel Reeves is, as we mentioned, under pressure, of course, to deliver new spending cuts or tax rises. What a debacle for the Chancellor. We discuss the latest next. This is Bloomberg.
It is normal for the price and yields of gilts to vary when there are wider movements in global financial markets, including in response to economic data. In recent months, moves in financial markets have been largely driven by data and global geopolitical events, which is to be expected as markets adjust to new information. UK gilt markets continue to function in an orderly way.
Chief Secretary to the Treasury, Darren Jones, speaking to the House of Commons about the wider market sell-off in UK assets. Of course, the argument he was making there was the same argument was being used by Liz Truss back after the mini-budget, and that wasn't given much credence by the Labour Party. UK Chancellor Rachel Reeves came into government, of course, promising higher growth, economic stability, security and stability in the public finances. 6 months in, and her project is close to being in tatters as she struggles to maintain the confidence of financial markets. Let's bring in our UK correspondent Lizzie Burden, of course, for the latest. Lizzie, what a week it's been for UK assets, and a reminder, of course, of the pressure that is on Rachel Reeves. We've been hearing from Darren Jones there, responding in Parliament. Talk us through what has been happening and the Labour government's response. Is it going to be enough to assuage investors?
Well, of course, because Rachel Reeves flew to Beijing last night, it fell to Jones to defend what was going on. He described the moves as orderly. The pound's been at its lowest in over a year. That, plus the rise in long-term borrowing costs, have drawn these comparisons to Liz Truss, of course. So orderly isn't quite the language that's being used in the city on the trading floor. You've got Citigroup jokes swirling around that the sterling is the great British peso, Wells Fargo and Deutsche Bank saying that there's room for the pound to drop further. To be fair, Sarah Breeden at the Bank of England, Deputy Governor, did also use the word orderly. That suggests to me that the bank is hesitant to wade into this. But economists say that the Bank of England is going to have no choice but to slow rate cuts, even if growth is weak. And you've seen that reflected in the market pricing. So they're only pricing 2 quarter-point cuts this year, even though Andrew Bailey signalled last month that 4 would be coming this year. OK, so pairing those expectations around the Bank of England and rate cuts, even, as you say, as growth stagnates here in the UK, will we get a growth lift from our relationship with China? Chancellor Rachel Reeves seems like a long shot, frankly. She's in Beijing or on her way, as you said. What is she hoping to achieve from this visit? Well, yeah, by the way, the Prime Minister's spokesman was asked, did she think about cancelling the trip given the market rout? And it was not even considered, given it had been in the diary for so long. You know, cast your mind back to the pint glass clinking moment with President Xi and David Cameron when he was Prime Minister. We are a long way from that. Keir Starmer wants to reset relations, but that sort of golden age isn't what Reeves is going for here at all. Clearly, China also needs to make some friends right now, and a huge part of this is going to be about a focus on opportunities for the financial sector. That's why the Bank of England Governor Andrew Bailey is going as well. But it doesn't stop the fact that the timing is risky. We're just over a week away from Donald Trump being inaugurated. You've already had some members of his team expressing their concerns that maybe this will show a weak point in the special relationship. You've had Peter Mandelson chosen to be the new UK ambassador to Washington. He's been a long advocate of better relations with China. That might not endear him to the new US administration. The EU's also trying to put pressure on China over the war in Ukraine. There's a lot of short-term downside risk for a trip that we understand isn't going to yield any big announcements. OK, Lizzie Burden, thank you very much indeed, setting us up for that trip and what to expect. Maybe not a huge amount, but maybe there's some important symbolism there, at least in terms of building out that relationship. How should the UK approach its economic relationship with China? We're going to discuss that with former UK Business Secretary Vince Cable. That's coming up at 7:30 a.m. UK time. Coming up, Wall Street's top banks said to be planning to give out the biggest bonuses since the pandemic. This is Bloomberg. Good Friday morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks slide ahead of key US jobs data that could shape the outlook for interest rates. The Yuan steadies after China's central bank makes a surprise move to stop buying government bonds. 180,000 people have now been forced from their homes in Los Angeles, with firefighters battling to control new blazes. President Biden promises the government will cover the state's costs. And Donald Trump says a meeting with Russian President Vladimir Putin is being set up as the president-elect restates his call to end the war in Ukraine. Checking in on these markets then on a big day on the data front, of course, with non-farm payrolls, jobs data out of the US
Later today, the print for December, the estimates are that you'll see jobs growth of around 165,000 for December, down from plus 200,000 in November, but nonetheless showing a solid labour market in the US. We'll see what the data actually comes through at. European futures currently pointing lower by 0.2% after actually posting some gains yesterday, and the FTSE 100 was also up by the end of the close. Currently flat, though, for UK equities. The FTSE 250 has been more challenged. Those domestic-focused stocks, of course, given the angst around the UK economy. S&P futures then stateside as the US equity markets look to reopen after yesterday's closure. Currently flat. Nasdaq 100 futures pointing lower by 0.1%. Let's flip the board and have a look at treasuries then. And there could be some movements, of course, particularly near the front end as we get that non-farm payrolls data. The 10-year is currently yielding you 4.69. The pound remains under pressure after dropping to the lowest level in a year. Currently at 122, down 0.2%. The Chancellor heading to Beijing. Brent at $77 a barrel, up 0.5%. And gold gaining in the session, up 0.3 for the yellow metal. Let's flip the board and have a look at the Asian session as well. There's been more pressure on China's equity markets. You are nearing a bear market now, at least according to one closely watched China gauge. And you can see that the MSCI China index down 1% in the session, close to off by 20% now since October of last year. So closing in on bear market territory for Chinese stocks. We had the PBOC coming through with a surprise announcement that it would stop buying bonds, at least for now. CSI 300, the benchmark on the mainland, currently down 0.9%. And the focus, of course, in terms of suspending that bond buying is to support the currency over in China, currently at 735 on the Chinese offshore yuan. The Nikkei over in Japan, down 1%. So a tough day as well for Japanese stocks at 39,190. Now, US tech billionaire Elon Musk has waded into Germany's election with a conversation with a far-right candidate, Alice Weidel, on his X social media platform, which amounted to an unpaid advert, essentially, for the AfD. Let's bring in Bloomberg's Oliver Crook with the details. Ollie, you've spoken to the leader of the AfD yourself in a different context. You actually posed some difficult questions for her. What was discussed between Musk and the head of the AfD?
Yeah, Tom, I mean, listen, this was a really very, and I'm going to say wide-ranging conversation. I think it's really fair to say wide-ranging conversation. It sort of began on sort of energy policy and some of the issues that she has with renewable energy and Angela Merkel and these sorts of things. It then moved on to sort of immigration and got into the sort of woke mind virus sort of stuff that, I think was really set up there for Elon Musk to sort of bite on. Immigration, the war in Ukraine, but it also went to, Adolf Hitler, colonization of Mars, and whether or not either of them sort of believes in God. So this was over an hour, really a sort of very, very long and meandering conversation. I mean, it began with about 175,000 listeners. It reached a peak at around the sort of subject of immigration. It was interesting to see the numbers sort of ebb and flow, because you could always see how many people were listening. And when they were talking about energy for a while, it went down to about 100,000, came back to about 200,000 when they were talking about immigration. But really, this is a sort of live event on the X platform that didn't really ever break much more than 200,000 people listening to it. And there were certainly also some dubious claims that I think are worth rectifying just here for the record. Basically, Musk introed her as basically the number one candidate going into this election. This is, of course, not true. There's not a single poll in which the AfD is the number one candidate. They're the number two candidate with about 20% of the vote. There was also this sort of long conversation about how Hitler was actually not a far-right figure, but actually was a communist and a far-left figure. I think very few people agree with that position in the sort of historical or really any community, and also saying that sort of the AfD is the only party that can actually preserve the life and safety of the Jews in Germany because of the sort of a lot of sort of Muslim hate towards them. Again, these are things that are just not true in any sort of sense of the term. But what I think is interesting is that by the end of the conversation, again, a lot of these topics were sort of intended to sort of tee up and slam dunk for both Alice Weidel and Elon Musk. And Elon Musk, by the end of the conversation, basically reiterated his sort of support for the AfD, saying that they're really the only common sense party in Germany. They only can save Germany, end of story, and that people need to get behind them. But that was basically the sort of thrust of the conversation, which again was about an hour and 10 minutes and really hit basically almost every possible conceivable topic, if you want to look at the range of things that people could talk about.
And we know the EU has said that they were listening in and watching as well as to what was happening. Does it move the dial, Ollie, do you think, for German voters?
Yeah, so listen, I think let's just first deal with the sort of regulatory side and the governments. The German government was certainly listening. The EU was listening. There's some questions about whether under the Digital Services Act at the EU that basically they could say that Elon Musk is doing something inappropriate in terms of interference or excessive sway in terms of European politics. We will see sort of where they sort of go with that. I think that it was an interesting conversation, Tom, because I don't really know how much of this was designed for the domestic audience within Germany. I mean, Elon Musk himself, I think, also exposed, the amount that he maybe doesn't even know that much about the AfD. The conversation was held in English. It was really sort of, he set it up by saying, for those of people who have never heard of the AfD, kind of what would you like, what would you like them to know about it? What I think is interesting is for the AfD and Alice Weidel, and this came out in the conversation that we had with her, is that she's really trying to move away from this idea of them being far right and more being sort of libertarian conservatives. When you look at their economic platform, there is some credibility to that claim. They want very, very small government, very, very little regulation, cutting taxes. But when you look at the sort of social and cultural side of their party platform, you can't really say that they're libertarian. They want a much stronger, much more powerful police state. They believe that Islam is incompatible with the German society, and they really want to preserve sort of Germanness. And in this way, it's very hard to make that sell within a party that itself has a lot of divisions that will really only ever be tested if they get closer to power, because right now they can just stand from the sidelines and basically slam the establishment.
Okay, Bloomberg's Oliver Crook, thank you very much indeed, joining us out of Berlin. To a slightly different topic right now. Wall Street's top banks said to be planning to give traders and deal makers their biggest bonus increases since the pandemic. Let's bring in Bloomberg Deals reporter Manuel Baiguri. Manuel, great to get you on this. You watch the deal-making process. That is part of the underpinning to executives' expectation that maybe they can hand more cash, more bonuses to their teams. What details do we have on these bonus hikes?
Yes, Tom. I mean, a very important part of the industry, right? And that keeps the attention of many of the deal makers. I mean, we are seeing a big shift into this year as the bonus season approaches. I mean, we come from a couple years in which bonuses for investment bankers, were kind of put a little bit on hold. They came from some waves of big increases, all the way up to the coronavirus, and then it was brought to a halt for quite some time. Now we are seeing banks like Bank of America, JP Morgan, Morgan Stanley, potentially coming out of that with double-digit increases for some of the business lines, those including traders and deal makers, which may see over the coming weeks potential increases of 10 or 15%, and those could go even farther, according to some consultants that have their own estimates, but it still remains to be seen. I think the pools were set towards the end of the year, and then in the coming weeks, those conversations will start taking place. And of course, that will vary ultimately individually for the top performers or the underperformers as usual. So the variation can be quite wide.
Okay, so the variation is there. Manuel, what does it tell us about the health of the industry more broadly?
Well, I think it's a good sign, Tom, given that this is based on cycles, right? We've seen over the decades, through the booms and busts, how the bonus can shift really, really rapidly. I mean, some bankers may reap millions in the good times, and they may get very little in the bad times. So I think it's a good sign. To your point, I mean, it reflects. Part of that reflects the uptick in business from the back end of last year, but also, perhaps more importantly, also reflects on some optimism towards what's to come in 2025, and that's good, because definitely the business needs that kind of optimism to thrive. So for traders, investment bankers, I think the outlook is slightly better as we come into the new year.
Okay, Bloomberg Deals reporter Manuel Baigori joining us with the lead and the details on what could be a bumper bonus season for bankers out there. Manuel, thank you very much indeed, with a look ahead as well to some of the deal making possibly in the pipeline for 2025. Now back to the US with a focus on the social media company of the moment, of course. It is TikTok, set to appear before the US Supreme Court in a last-ditch bid to avert a ban set to come into force on January the 19th. Yes, the clock is ticking down. One day, of course, before President-elect Donald Trump is inaugurated. For more, let's bring in our opening trade anchor, Kriti Gupta. What is the potential fallout then, Kriti, if this ban goes ahead?
Well, so I don't think anyone really thinks about the effect on big tech, but that's exactly where you're going to see it, because the primary move that you're going to see if this ban does indeed go through, which is the expectation, right, by the way, despite the appeals court hearing that is set for today, is that come January 9th, one day, as you mentioned before, Donald Trump is put in office, the app is going to be removed from the likes of the Apple app stores and the Google app stores. And that, of course, could really prevent TikTok from issuing things like app updates and really keeping up with technology that some of its competitors may be harping on. So that's going to hit from the Apple and Google point of view. From the social media point of view, Google may actually benefit, given that they have that massive YouTube business. Meta as well expected to take on that. Oracle, on the other hand, and this is, I think, a little-known fact, trying to make waves in the cloud space, is the number 3 competitor globally in the cloud space as well, really competing with the likes of Amazon and Alphabet as well. They actually have a major contract with TikTok in terms of hosting that data on their cloud servers, and that's something that could really hit their bottom line.
Yeah, the interlinkages to the wider tech sector are there, aren't they, in terms of TikTok? What is the chance that maybe there is a buyout? This had been part of the conversations when Trump had initiated, back in his first term, a potential ban of TikTok. He's walked back on that. There were some discussions at the time. Maybe Oracle would have been involved. Is a buyout possible?
Under Donald Trump, it kind of looks like it is. I mean, take a listen to just what he actually had to say. He filed a court briefing in this case of TikTok versus Garland. I'm just going to read the verbatim from the filing, if you don't mind. Donald Trump, talking about himself, possesses the consummate deal-making expertise, the electoral mandate, and the political will to negotiate a resolution to save the platform while addressing the national security concerns expressed by the government. He's no longer just talking about this in the press. He is actually making a filing in the Supreme Court. That's how much he believes that he can actually find some sort of deal. The question is, who actually are the potential suitors for this deal? And that's where big tech comes into play. Again, Morgan Stanley putting out a great note last month saying that it could be something like Amazon, for example. TikTok Shop is a big kind of a piece of the TikTok story. Amazon is the largest kind of e-commerce player globally in that space. Microsoft has been talked about as a potential suitor back in 2021. Walmart apparently approached in 2020. Even Oracle, given they already have that stake in there. And then a group called Project Liberty is another one, really talking about a lot of the folks who maybe want to keep those First Amendment freedoms. That group that includes the likes of Kevin O'Leary may actually also put a bid forward.
Kriti, thank you very much indeed. Opening trade anchor, of course, on the fortunes of TikTok and the impacts on the broader tech sector. Kriti Gupta, anchor of Opening Trade. Coming up, we're going to discuss the outlook for oil and gas this year with Francisco Blanch, the head of global commodities at Bank of America Global Research. Stay tuned for that interview. This is coming up. This is Bloomberg. Welcome back. Oil set for the best run since July as signs of market tightness offset concerns about demand weakness in top importer China. Joining us now for more on commodities and the wider markets is Francisco Blanch, commodities and derivatives head at Bank of America Global Research, someone really well positioned to talk about these commodity markets. Francisco, thanks for joining us in the studio this Friday morning. Talk about what's underpinning oil at this point. Despite concerns about China's economy, there's some signs that maybe inventories are shrinking in the US. Is that what's putting the support under? And are we looking at a breakthrough 80 in the near term?
Well, so Tom, we think oil's been supported by weather for the most part, right? We've had a cold snap. We've had a strong performance in heating oil, diesel, but also crude oil, which has been rising in sympathy with that. Obviously, OPEC took a measure to extend the cuts in December, which means we have less supplies than the market may have anticipated in the first quarter. We've had Brazil, which is one of the big one of the incremental suppliers of oil from non-OPEC this year, underperforming their own expectations. So there's a number of factors. I still think that oil is likely going to come off into March, and the main reason is we do think that the market is in surplus. We have probably more barrels of oil coming in on the supply side than the market wants to buy, because at the end of the day, we're still in a very frail macro outlook. We're still in a frail industrial outlook here over the course of the next few months.
Okay, so Brent is at $77 a barrel. You do think the market is still oversupplied, despite the support we've seen to prices in recent weeks. Where does that leave your kind of target range?
We probably think Brent kind of rolls down below 70. We're looking for $65 a barrel Brent into the next couple months. And again, I do think there's a winter element to it. Remember, we've had global gas rising as much as $15 per MMBTU, which is close to $90 a barrel. That's kind of roughly in parity with diesel, gas oil, heating oil. And we think that kind of comes to a bit of an end over the course of the next month as refineries go into maintenance. Okay. So we're going to have more of a normal refinery maintenance season this year. Thereafter, it's hard to say. I think. Look, global markets are at the edge of a new administration in the U.S. We could very well see broader risk-off in markets within 10 days, and part of it is there is a lot of uncertainty around what's going to happen. Everyone's talking about tariffs, talking about immigration, talking about tax changes, but nobody really knows, right? I just attend investor dinners and lunches and discussions with different corporations. Nobody really knows what's coming down the pipeline. We have a sense that maybe there's tariffs, but we don't really know what those tariffs are going to be, how they're going to be applied. We know tax changes are coming. Don't really know those are. So, and I think in the same time, we're seeing long-dated yields, long-dated interest rates coming up very quickly in the U.S. with a big steepening of the yield curve. So this is all pointing to a complicated macro outlook in the next month or two.
Yeah, so the uncertainties are there on the policy front from the incoming Trump administration, as you say. But there are things that we do know, at least broadly. Tariffs are coming in some form. That is the expectation. Right. Canada could be in the spotlight. Iran could be another factor for this incoming administration. But this is also an administration that's going to go back to the drill, baby, drill. And we expect Trump to push through in permitting, U.S. lands, more drilling. Those two, is Trump a support for the oil markets, or is Trump putting a cap on prices because he's going to get more output from the U.S.? Tariff impact on Canada, Iran versus more production in the stateside.
Right. So you mentioned tariff. You also mentioned Iran and sanctions, right? I mean, we don't know which way Trump's going to go in Iran and Venezuela. There's also the inauguration going on in Venezuela, as you probably know, right? I mean, we're going to. I think we could very well experience meaningful supply losses out of those two producers, and that will change the balances meaningfully. Remember, we are 2.2 million barrels a day above the levels of production between Iran and Venezuela, where we were relative to the end of the first Trump administration, because of the sanctions that he applied back then on those two countries. So we could get back to that. Mm-hmm. There's, of course, Russia, Ukraine. How does that unfold? Huge element for energy markets. Remember, we just lost Russian gas flowing through Ukraine because of the end of the transit agreement only 10 days ago. So there's a lot of uncertainty as to how Trump will deal with Russia, with Russia and with Iran, yes, and Venezuela, and could very well change pretty dramatically. And then to your point, the whole tariff situation, what worries me the most, I think the tariffs are going to be centered for the most part on China, and this means the one currency that's likely to weaken more is the Chinese currency, the Chinese yuan. Of course, that will be exacerbated by the weakness in the Japanese yen. But I do think the Chinese will have to let their currency weaken here if those tariffs start to build up. And that's never good for commodities. China is the world's #1 buyer of commodities across the board, whether it's energy or it's metals, also a huge consumer of agricultural produce. So a weaker Chinese currency probably means lower commodity prices in our view.
Before we let you go, gold up about 30% in the last 12 months. Do higher rates, or at least rates held higher for longer, derail the prospects for gold?
They don't fully derail the prospects for gold, but I do think they put them on pause until we can get back to that lower interest rate path that we were on in 2024. And the reason, again, go back to the idea of currency and tariffs. Central banks need the liquidity, the dollar liquidity, to support their currency. And if you're selling If you're selling something, you're going to be selling T-bills to buy your own currency to make sure your depreciation is accommodated as those tariffs come through. So I think central banks aren't as much in the game right now of buying gold. They still want to own gold long term, but right now, tactically, they probably need more liquidity to deal with the change.
You stick to your $3,000 target this year?
End of the year, yes. In the short run, I think it's going to be pretty choppy for gold.
Francisco, fantastic. Thank you so much for taking the time. Coming to the studio this Friday morning. Francisco Blanch, Commodities and Derivatives Head, of course, at Bank of America Global Research. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. It is Jobs Day, counting down to the non-farm payrolls out of the US later today. The estimates, expectations are you're going to get a print of about 165,000 in terms of additional jobs for the month of December. That is down from November when you got a print of 227, but nonetheless still solid and expected. This is the estimates coming through from the economists, expected to support that view from Fed officials that they can take a cautious approach to future cuts, of course, from the Fed. The unemployment rate, 4.2%. That is the expectation. It is up from the start of the year, of course. Start of 2024, you're at 3.7%. You've moved higher to 4.2%. But that's not deeply uncomfortable yet for the Federal Reserve. There are parts of the labour market that are looking a little bit more vulnerable in the US. So the details on the jobs data will, of course, be consequential and could feed into moves around the Treasury curve. Let's flip the board and have a look at what's happening here in the UK with a focus on the equity markets, which are showing a little bit more resilience if you look at the futures at least, and have done yesterday. But here's the split. Domestic versus internationally exposed stocks here in the UK. The blue line, the internationally exposed stocks, there's the crocodile mouth shape that you're seeing with the hit and the pain really coming through for the domestically focused stocks, given the pressure on the pound, the concerns about the debt, the concerns about lack of growth here, and the concerns about higher prices. And you've seen that play out for the real estate players, the builders in the UK, but the retailers as well. So watch that dynamic going forward. Later this morning, the Vice President of France's largest employer will be speaking to us at 8:30 a.m. UK time. The opening trade, though, is up next. This is Bloomberg.